Welcome to the lecture for part 2 of chapter 5. We're going to cover a couple of different subjects rather in this section. The first thing I want to talk about, which will help you with exercise 5-8, which I will post a video of some worksheets that we'll work through for that, is a more realistic example of what happens with FIFO. So in the first lecture for this chapter, we dealt with a company where they started with beginning inventory, they made a purchase, and then made a sale. And so it was pretty straightforward to, when there's one sale that happens after all the purchases, to figure out, well, where's that inventory that's being sold coming from? So this example is a little more realistic. And keep in mind that a company would do this, or their computer software would do this, for every single item that is sold. So if you came into the school bookstore and bought 5 different textbooks, they would determine the cost of each book using this system. So this would be done 5 times in a sale like that. So in this example here, we have a beginning inventory, 100 units, $20 each, $2,000 in inventory. We make a purchase of 200 units at $21.50, so we have inflation taking place here, costs are going up. And then we make a sale. And in FIFO, again, we're giving customers the oldest stuff. So that sale of 220 units, we're going to give them 100 units from the beginning balance, which is going to wipe that layer out. And then we'll dip into the most recent purchase for 120 units to make the 220 that we sold. So that will give us a cost of $45.80 for that particular sale. Then we have the inventory balance after the sale. That's the 80 units that were left from our purchase on February 14th at $21.50. And then we have another purchase of 160 units at $22.50. So now we have 2 layers again. We sell 100 units, so we're going to take the oldest first and give them the $21.50 units. And then we have to dip into the $22.50 units to give them 20 more to make the sale of 100. After that, I'm left with 1 layer because the $21.50 layer is now gone. So I have 140 remaining of the $22.50 units. And then I purchased 280 at $23.50. So I'm back to 2 layers. Then I sell 330, so that takes all of the 140 of the $22.50 units away, and I have to dip into the most recent purchase for 190. So then at the end of that, I have ending inventory of 90 units left at $23.50 for $21.15, and I have cost of goods sold totaling $14,365. So again, the key to this kind of problem is to be very methodical. And don't try to skip a step because you'll get confused. So in every case when you make a sale, think about the layers of inventory you have and think about giving the oldest ones to the customer first and then building up from there. And always keep track of what your inventory balance is after the sale. Again, I'll work through a problem for you with the document camera, and that should help as well. Okay, so the next subject I want to talk about is lower of cost or market. And there's a little bit of a glitch in the book I wanted to point out there. They talk about market cost and a replacement cost, and it really should be market value. So what's going on here is at the end of every year, we want to look at all of our inventory and compare the costs that we're carrying it at with what we could get if we were to sell it right then. So the point here is that in some kind of businesses, the market value has fallen, okay? Computer chips is a good example. I might buy a bunch of computer chips and then they come out with a new computer chip and the ones that I have are now worth less money. So if that's the case, I want to make that comparison every year. And if I have something where what I could sell it for is less than what I paid for it, I need to recognize the loss then rather than to carry that value, that inflated value, and recognize the loss later. So I want to recognize the loss in the period in which it goes down. So we could do that exercise either on an item by item basis, which is the most conservative way to do it and the most common way to do it. We could do it based on classes of items. So example, our bookstore could look at the total market value of textbooks versus the cost, the total value of clothing versus cost, and the total value of office supplies versus cost. Or we could do it as the inventory as a whole. What is the market value of the entire inventory? What's the cost of the entire inventory? That'll result in the least number of write-downs. So again, the individual item is the best way to do it because it doesn't allow margins on some items to offset losses on others. So here's an example how to do this mechanically. We have 4 items in inventory, A, B, C, and D, with different quantities there in column A. And then I have my unit cost. So that's what my cost is for that particular unit. So if there's multiple layers of that unit, for example with FIFO, this would be the average cost of that of those layers. And then I have the market value. That's what I could go out and sell it for. So the total cost and the total market value are just extending those, and there's a typographical error there. It should say A times C on the second column, or the total market column there. So we do the math. As an example, total cost for item A, I have 320 units times 2150, that's 6880. Total market value, 320 times 22, that's 7040. And then the last column is me just selecting the lower of those two numbers. So in the first case, the cost is lower. In the second case, the market value is lower, so I choose that figure, which is also the case with C. And then in D, the cost is lower. So in this case here, I would look at what the total cost is and what the lower of cost or market is if I was doing it on an item by item basis, and I would write the inventory down from 30,020 down to 28,410. So I would reduce the value of my inventory and recognize an expense, which is effectively recognizing the loss that has occurred on items B and C. If I was doing it for the entire inventory, I would just write it down for 30,020 to 29,120. So again, I will go over a problem that'll help you with this one as well. The next thing I want to talk about is the effect of errors in inventory. So in the first column there, I'm showing what if the ending inventory is accurate. So I count $3,000 worth of inventory, and that is the correct figure. I should have cost of goods sold of $7,000. Okay. If I overstate my inventory, if I count more than I should, then I'm going to have a higher ending inventory and a lower cost of goods sold, which is going to give me a higher profit. Now the following year, if I correct that error, it'll reverse and flush itself out. Okay, so hopefully that makes sense to you. And then working through a problem, I think, will help in that regard. The next one, the last topic I want to talk about, is estimating ending inventory. So in some cases, you might have a fire or something like that that destroys a bunch of inventory, or somebody breaks in and steals a bunch of your inventory, and you need to figure out, well, how much do I have left at the end of the period? Well, one way to do that is to say, well, I know what my beginning inventory is, and I know what I purchased during the year, so I have goods available for sale of $23,600. Okay, so if the sales through June 30th, when the loss took place, were $22,000, if I know what my margin is on that, like say my margin is normally or historically 25%, then I could deduct what the margin was from the selling price. $22,000 is what I charge customers, not my cost. Okay, so if I take that $22,000 and I subtract the margin, then my cost would have been $16,500. So if I deduct $16,500, that is my estimate of what the cost of the goods that left my store was. So if I had $23,600 available and $16,500 left my store, my ending inventory should be $7,100. Now this is useful for a couple of different ways. One, it's useful, like I said, if we have a loss and we need to figure out what was there for insurance purposes. The other benefit of this is I could determine what my ending inventory should be, and I could go count it. If I don't have a perpetual system, I could count the inventory and see if maybe there's some fraud going on or theft or something like that. So it's a way of kind of backing into that assessment. So that is the end of the second part for Chapter 5. Again, please check out the video that I'll post shortly for working through some homework problems. So thank you, and as always, please shoot me an email if you have any questions. Thank you.